Welcome again to Wall Street Sizing Up. We've got a great edition today. We're going to talk about something that I know that you've asked yourself, and I ask myself all the time. Should you buy stock when it's at an all-time high? And I think that you'll find it very interesting because the results are surprising. With that said, I've got some housekeeping items I've got to get to. We are now owned and operated by StockTrade.tips. That's StockTrade.tips. They have one goal. That one goal is to profit off the insider knowledge of the hedge fund. So part of that is that if you haven't looked at our Twitter account, it's at Trading Heavy. You can see it here at Trading Heavy. This is where 24 hours later we post all the 13G and 13D SEC filings of the hedge funds who have sized up and on what stocks and how many shares and what it's worth. So that's 24 hours later. The premium SMS subscribers get this 24 hours before it goes up on the Twitter, and they get the cream of the crop. So with that said, guys, let's do what we came here to do. Let's talk about should you buy stocks or should you buy a stock when it's at an all-time high. Jake hit the theme. Let's hit the casino. Let's go. One thing that we like to do on this channel, that if you've watched the channel for any amount of time, we've now been doing this for about 4 months, but we do bonus coverage. And when I say bonus coverage, we're not just going to do stocks today, right? We're going to do, should you buy stocks at an all-time high? Should you buy international stocks at an all-time high? Should you buy alternative assets at an all-time high? And that includes gold and that includes Bitcoin, which we all know is at an all-time high. So there's a guy named Nick Maguli who is COO of Ritholtz Wealth Management. I have seen him on the channel. So even before I started the channel, I remembered the name Ritholtz. And they seem to have sized up. Now they have a wealth management arm, clearly. So they must have some type of fund arm too. And so that's what caught my eye when I was kind of scrolling through Twitter. And I started following Nick. Then I got to his newsletter. His newsletter is called, as you see on the screen here now, ofdollarsandData.com. That's where you can find it. But the newsletter's name is Of Dollars and Data. And so here's what we're going to talk about, right? And that is, should you buy at all-time highs? Nick states. Now, Nick is the COO of Ritholtz Wealth Management, well-respected in the field, in the industry. Ritholtz has quite the AUM. So, after all, nobody wants to deploy their capital right before a crash and then wait years before seeing a return on their investment. We can all agree with that. As I have shown previously, there is only a 5% chance that you are going to buy an asset, like a stock, at its best possible price. That means at the bottom. There's only a 5% chance. This means that there's a 95% chance that you will buy too high relative to some lower future price. Does this imply that you should buy near all-time highs? Well, not at all. In fact, the data suggests that for many risky assets, including stocks, Bitcoin, gold, all-time highs are a bullish indicator, at least in the near term. Why? Because all-time highs tend to follow other all-time highs. All-time highs begets other all-time highs. There's some FOMO there, but for the most part, we're talking about momentum. You know who's the biggest momentum trader? That'd be Kathy Wood at ARK Invest. She is absolutely a TA professional, but beyond that, she trades momentum. She likes to see that. I'm sure there are many strategies, but that is what she is known for, and that is momentum trading. Now, following all-time highs, this process won't last forever, but it can go longer than you think. When you think of all-time highs, you think of fear. You think of it represents uncharted territory, unknown, it's going to dip, blah, blah, blah. But what you should really think about when you hear all-time highs is more buying, period. That is how the markets work. Essentially, you've got more demand than you have supply for the shares, which drives up the share price, right? When more dollars are trying to get into an asset than are trying to get out of the assets, prices rise. Hence Bitcoin right now, right? And you won't be diluted in Bitcoin. And if this behavior continues, prices will continue to rise. This is why all-time highs tend to follow all-time highs. Higher prices attract more buyers, which attracts higher prices. It's the reflexivity. It's also FOMO.
FOMO, fear of missing out. I used to get the old FOMO. Oh.
Is involved there. So on the screen with the graph, you'll see in the red there that this is the S&P all-time high. So you can see, when are you going to invest that's not at an all-time high? Very few spots in there. This is from 1950 to the present. Very, very little spots to invest in the S&P, right? Because it's seemingly always within 5% of all-time highs. And you can see the spikes here. While it is easy to look at this chart and focus on the few large spells between all-time highs, what you should really be focused on is the many, many short spells at the bottom. Most of the action in the chart is happening near the base or the horizontal y-axis. This is why the S&P 500 has been within 5% of all-time highs nearly half the time since 1950. So the S&P and most stocks in the S&P is what he's saying too, have been within 5% of their all-time highs 50% of the time, going all the way back to 1950. That is a mind-blowing statistic. Explosion. But what about performance? How does the S&P perform following an all-time high? As the distribution plot below shows, when the S&P 500 is near an all-time high, returns over the next year are similar to those when the S&P is more than 5% away from an all-time high. So basically what he's saying is, if it's down 5, 10, 15%, it performs virtually the same as it is when it's at an all-time high. You can see it there. It's almost a mirror image. If it's off the all-time high more than 5%, it does skew a little bit more positive. It looks like the average is probably around 12. If it's on an all-time high, it looks like it's around 7 to 10, if I'm just eyeballing the chart correctly, right? The plot suggests that the fear of crash following all-time highs may be slightly overblown, right? Clearly that can happen, but not likely. And if we look over longer periods of time, investing in the S&P 500 near an all-time high becomes even more compelling. As the plot below shows, the average annualized return over the next 3 years when investing near an all-time high is slightly higher than the average annualized return when further away from an all-time high. So basically what he's saying is, if you got in at an all-time high, in the next 3 years, you're going to do even better. Now, this is unbelievable.
I can't believe. Right, well.
You're going to get an annualized return. It looks like the average there is about 10%, right? Now, if you're off an all-time high, it looks like it might be about 12%, and then it really, really drops off, whereas the near an all-time high can really, really stretch out further. So, again, you shouldn't be worried about essentially buying it at an all-time high. Of course, we have no idea if this relationship will hold in the future, but the data should provide you some comfort when you invest near market peaks, which we're in now. He even goes to show, we'll get to it in just a second here, but he has a friend, and the friend compares a buy and hold strategy to a strategy that only invests in stocks at all-time highs. And then if the stock is not at an all-time high, it switches into interest-bearing bonds, right? So essentially non-risk bonds in all other months. Surprisingly, the strategy that only bought at all-time highs had a better performance and lower volatility than the buy and hold strategy. Go figure. Let's look at that. So this guy named Meb Faber. It looks like he goes by Jake, from what I can tell here on Twitter. So that's probably his middle name. So here's what he does. What if you bought stocks? So this is his experiment. What if you bought stocks at all-time highs? Otherwise, you sat in the safety of government bonds. Jake found that it turned out you actually outperformed just sitting in stocks that are at all-time highs. What? What do you mean? That's crazy to even think of or even say, right? It turns out it's a pretty good strategy. Better returns than just stocks. Lower volatility and way lower drawdowns. Again, all you do, this is how he did it. All you have to do is check at the end of each month. If the stock is at an all-time high, then you invest more in that stock for the next month. Then you check it again. If it's not within 5% of an all-time high, you go back to bonds. That's it. Guess what? That did better than the buy and hold. I am not advocating this strategy in the least bit, although the back testing back to 1950 clearly shows it's a better strategy than buy and hold. But who wants to check, every stock that you have, every ETF that you have at the end of every month? If that's your job, if you're on Wall Street, if you're IB, certainly might be something you want to look into. So clearly he got some flack on Twitter. There were a lot of people who were in disbelief, so he went back and he checked the code. And the results below are confirming. So he's talking about this chart down here. The results below are confirming. And the best part is you're only invested about 1/3 of the time. So he did it for each asset class, not just stocks, but he also did it for REITs and gold and stocks and foreign stocks. And you're only invested about 1/3 of the time in each of the assets, right? So if the asset is not at an all-time high, he went to safe bonds, right? And it outperformed buy and hold. That is crazy, right? So again, not advocating for you to always buy and then get out and go to bonds at the end of every month. I'm not advocating the strategy. I like the buy and hold. One, it's simpler, and two, that's just what you want your 401k to do. But certainly not a bad strategy, something that I did not know. But let's talk about international stocks. So if you look at the graph again and you see the red, that's the all-time highs. Not a lot of places to invest. It's literally always in the emerging markets, and he quotes two index funds or two ETFs here. The red, they're at all-time highs. So it's always within 5%, except for very few years, going back to, again, 1970. Emerging markets all-time highs, you can see it here, right? And that goes back to 1989. So I was wrong, right? So the emerging markets, both are showing the index value as far as you want to go back, that if you're investing at all-time highs, not a bad strategy. In fact, because of this clustering, the data suggests that investing within 5% of an all-time high has provided better returns than when investing further away from all-time highs, which we know, but it gets better. In emerging markets, the effect is even stronger, since the average return following an all-time high on an annualized basis is 16.8% compared to only 8% when it's off an all-time high, or it's not within 5% of an all-time high. Look at that. That's crazy. That is absolutely nuts, especially emerging markets. Annualized return skews far better, almost 2x, if you invest at an all-time high in a stock of an emerging market. That is crazy. So, nevertheless, this data provides more evidence that investing near all-time highs is less risky than it first appears. But what about Bitcoin and gold? Let's talk about it. Fortunately, investing near all-time highs in these alternative asset classes seems to be a good bet most of the time. Now, on the screen, it's showing the annualized return for Bitcoin. The blue is when it's off 5% from an all-time high, and the red is when it's within 5%, right? Again, same exact chart. Now we're just talking about Bitcoin. Look at that. Literally, I would say the average there has got to be around 250% return the next year. That's crazy. As you can see, the returns are clearly better when Bitcoin is near all-time highs than when it is further away from all-time highs. Okay. However, Bitcoin has also been an asset class that has had its share of dry spells between all-time highs, with the most recent being the one lasting 3 years. Yeah. So in December of 2017, we hit an all-time high like 19.4, 19.5, right? Now we're at, I believe today it's like 28.8, but it has hit 29.2. It's been 3 years, right? And in March, it went all the way down to 4,000.
This just in, a diabolical, albeit haphazardly thrown together machine is attacking Bikini Bottom and is headed straight for the crusty.
So since Bitcoin is such a young asset class, we have no idea whether investing at all-time highs will be profitable in the future. But certainly in its 12 years now, or close to 12 years, it has been profitable investing in all-time highs. So what about gold? Same exact thing. Same exact. Now the returns are a lot less, but as you can see, when gold is near all-time high, it is far more likely to have a big positive return than when it is 5% or further away from all-time highs. And you can see it there. And literally, you can say the average there's probably, I don't know, 3 to 5% if I'm eyeballing that correctly. Bottom line is this: regardless of which risky asset class you have in your portfolio, as this post illustrates, buying near all-time highs should not be a cause for concern. Unless, caveat, right? Unless you're investing your entire nest egg into one asset class at a market peak, it is unlikely that buying near all-time highs will ever prevent you from living the life that you want and retiring the way that you want. And I completely agree. Warren Buffett says time in the market. Certainly that's what I do with my 401k. Although after this post, I will tell you this, that prior to this, I kind of knew about the time in the market, but I had left a lot of cash out from my 401k when the market went down 35 on a Thursday in March, right? Yeah, I jumped in with a lot of cash. But here's the thing, guys. I left 6 figures in cash and have been scared, or not scared, but I thought it was too risky because everything was all just kept going up and up and up and up. It's always at an all-time high. So I'm sitting in cash right now. After this, I hope this helps you too, because I'm going to invest the rest of that 6 figures in cash in my 401k and just let it sit there. I need to take my own advice. Time in the market, and that's what we're going to do. So I hope this helped, guys. This is probably going to come out on the 2nd or the 3rd. Maybe even the 4th or the 5th. We'll see. I'll have stocks to watch before then. But I hope you had a great New Year's Eve. That's when this is being recorded. Please, I hope you were safe. But with that said, guys, watch your 6 and go hard in the paint. Cheers. We'll see you next time. Hey, good evening, and whatever time it may be. We hope you enjoyed that video as much as we enjoyed making it. Please hit the like or the subscribe or leave a comment, because we love that feedback. And you know what we say. At the casino, you got to watch your 6 and you go hard in the paint, guys. Cheers. We'll see you next time.